Hello and welcome back to another episode of Fun Friday with a very special guest. He's been all over the podcast streets on the Lone Star Capital stream and guesting all over the place. But the newest member of the Lone Star Capital team, well, actually, he might not be the newest by the time this releases, but one of the newest partners of the Lone Star Capital team, partner Sam Morris, the Swiss Army knife for our team. How are you today, sir?
I'm doing well, bud. Good to see you again.
Yeah, likewise. Well, super excited to have this content and this podcast idea. So, this is actually going to be something for those who are listening right now. If you're a fund manager, or if you're an LP, maybe if you're someone newer to the business and you're looking to kind of find a North Star, if you're looking to save a lot of time, or even if you've been an LP or capital raiser, an LP, someone that's been in the business time, but you're kind of sick and tired of the time drag that goes into all the deals getting sent to you. You're getting people always sending you opportunities there, if you will. It's bottomless. Sam, you can speak to that better than anyone. I mean, when people know that you can raise capital, it seems as if people are always emailing you deals and opportunities. They're trying to court you to get their business. We were those people. However, we were one of the few that successfully ended the big fish there, if you will, multiple ways, not only to acquire a company, but also to get your business from a fund managing side. So I'll brag about us for a second, Rob and myself there and the team, of course. But that said, we believe that if you are in the business, as I said, as a fund manager or an LP, that this could save you maybe 80 to 90% of your time. So Sam has a very interesting insight into this because Sam has been multiple things. He's been an LP. He's been a fund manager. He's been an operator. He's been a banker, right? So he's been kind of all sides of the spectrum here, which is, I think, why Sam would be such a valuable person to obviously do this presentation. He's been doing it live at Tim Mai's event here, but we're also going to bring this to you all to save you some time.
Yeah, no, I appreciate that. And you're right. I mean, I would say every bit of 80, 90% of your time you could save utilizing these techniques that we're talking about, just because you're right. I mean, every single day, there's not a day that goes by that where, I don't get an email soliciting for capital. That's the nature of the world that we live in. And so, what we did was we came up with something that shows realistically that just, I broke it down into four things. I said that before you evaluate a deal, there's literally four things that you need to do that. And it's pretty simple from that standpoint. But, a lot of these things you can do once and you're done, which is really great. And so, from a presentation standpoint, the things we're going to talk about today are really those four key things to look for when you're evaluating in a deal, and it's specific for those that are investors or fund managers, right? And the things that you need to look for to help you to determine whether or not a deal is for you.
Yeah, and to piggyback off that, Sam, so exactly, if you're an investor, if you're a fund manager, this is specifically for yourself. And also think about this. If you are someone who's more experienced, you know someone that's a little bit newer, please send this information to them because this could really help them save time. So please share this to anyone you think this might be valuable. But also, even going a step further, if you're a sponsor and you watch this, we do get a lot of sponsors that actually want to watch what we're up to. They want to watch kind of how we're thinking about the business, which is it's very flattering. Often we go to conferences and we hear that often. If you're a sponsor as well and you're wanting to kind of get in the minds of an LP or a fund manager and kind of figure out what's in it for them and how they should be looking at this, to promote better culture within the industry, I think this will be valuable for you as well. So without further ado, the four key things to look for when evaluating a deal for fund managers and LPs. So this is very exciting. So,
Yeah.
yeah, about Sam, do you want to just give yourself a quick spiel? Just go.
Yeah, I mean, this is just by way of education. I'm a former banker, right? So I've underwritten, thousands of deals at this point in my lifetime, literally, and I've, both on the, the lending side and the investing side, done just a tremendous amount of deals over the last couple decades. But my favorite stat of all of that is the last one. I've been married to my wife for over 21 years and we have four kids, but that's pretty much the way I like to lead it. But yes, I mean, there's a lot of stuff out there about me, but I have gotten to do quite a few deals and have unique insights from pretty much every aspect of the life cycle of a deal prior to and ending it as well.
So what's really exciting for the Lone Star team is, Sam, I happen to notice 20 years of experience. Now, you might be thinking, who is this baby-faced 30-year-old talking? Yes, that is me. I'm Craig. I do not have market cycle tested. I haven't been tested through a market cycle yet. We're going through one right now. That's no doubt. But Sam, you have gone through a market cycle. Is that correct?
Yeah, I would say more than one at this point, both fortunately and unfortunately, however you really want to look at it. And so, but knowing a sponsor that has some battle scars, so to say, because they've been through it, learned it, is both a fortunate and unfortunate thing sometimes. But it's also something that when you're looking to invest, you want to know somebody who's at least been there, done that, and twice on Sunday kind of thing.
Certainly. And then just a bit about Lone Star Capital for those who don't know. Formed in 2018, acquired over $700 million of assets under management. We've gone full trip on two deals, meaning we've gone full cycle. Those deals were, in fact, value add deals in Houston that the net return delivered a 30% IRR over the holdings there. For those who are also wondering, those deals were exited in 21 and 22. To this point, we have not made a capital call or have lost any investor dollars or anything of that nature. I think it's super important to note there is those things. Well, a lot of people have got beautiful track records, but you look at what's kind of under the hood currently, and you'll see a lot of distress. We're in a very, very fortunate situation where we do not intend to make any capital calls or anything of that nature through this market cycle, which is something that we're very proud of. And I think it's also probably something that's attracted Sam our way as well, I'd imagine.
Absolutely, absolutely. All right, so getting into it, here we go. All right, so I put them out there. Here are the four things that we look for when we're evaluating deals, right? And it's really simple. These are one word, but what's really interesting is the deal itself is last. I think a lot of people have this, really backwards when they're going through things. They jump right into the deal to see if the deal makes sense, and it's literally the last thing that we look at. So the first thing would be alignment, and so much of that is just understanding who you are as an investor or who your investors are and what they're looking for. Obviously, the sponsor being the number two thing there. And the beauty about evaluating a sponsor and going through that exercise of evaluating a sponsor is it's typically a one-time thing. Meaning, if you know who the sponsor is and you know what they're all about, that isn't going to change too much from that aspect. Like from deal to deal, it's not normally going to change. The structure being the third thing that we look at, and we'll get into some of the details associated with that, because structure with specific sponsors, rarely change, or if they do, it changes minimal. And that's sometimes on a deal by deal basis too. So, you do have to make sure you know the structure, and obviously the last being the deal. And there's a lot of certain things that we look at when we're going through a deal itself. But realistically, the deal is the last thing that you look at. And, if you can check the box on 1, 2, and 3, you then go into the deal. But if you can't check the box on 1, 2, and 3, there's really no reason to even evaluate the deal. And so when we talk about saving you a lot of time, if you go at it in this order, you'll be able to save a lot of time, evaluating deals and understanding, who's doing what and where they're doing it. So that's kind of really important, is the actual alignment, the sponsor, the structure, and then the deal, and understanding that we kind of go in that order when we're looking at deals.
So let's get into alignment now.
Yeah, let's get into alignment. All right. So alignment is really your investor thesis, right? It's your investment thesis of the deal. Really, what kind of product do you want to be investing in? Because there's a lot of things that we can invest in the alternative space, right? So the very first thing we talk about is the product, and even sometimes the subtype. Because if somebody comes to me and says, hey, I really want to invest in retail deals in Oregon, I would go, man, that is great that's what you guys want to do, right? And whether or not I know somebody in Oregon who's doing retail deals, that may be somebody I would refer you to be able to do that. But I don't even need to show you my deal, and nor do you need to evaluate my deal if your whole thesis is we want to do retail deals in Oregon, right? That's okay. That's great. It takes, everybody has different investment thesis, right? But if you go, look, I really want to do multifamily deals in Sunbelt states, well, hey, I may have something that's available for you that we can actually get alignment on, because that's a space that we operate, right? We're in the multifamily business really for the state of Texas. I mean, that's really what we do. And so we may have a deal that could fit your subtype or what your investor needs are. And understanding what those needs are really allows you to really sift through and get rid of probably 95% of the deals that would come across your desk, right? If it's not what you're wanting to invest in, there's really no reason to go in and start underwriting it. And so, what we have here, there's a lot of product types that are out there. Multifamily, which is what we specialize in, but there's other real estate assets that are out there, other different classes. You can do retail or office or build to rent. There's other asset classes that are out there that may be attractive from either a diversification standpoint, or what you want to invest in, right? And then there's other non-traditional alternatives that are out there that have nothing to do with real estate at all. So there are a lot of different things that you can invest in, and understanding what it is that you want or what your investors want can help alleviate you from doing a lot of just busy work that just doesn't need to be done.
Well, it's so interesting, Sam. You raise a lot of great points, from the alternative asset space, which is crazy that multifamily is even considered an alt. But, multifamily is probably like the shallow end, the warmest water there, if you will, of investment, alternatives there, if you will. Then you can go as far as to ATMs, oil and gas deals, everything in between, right? It's a very vast space. And then if you just go bringing it back to multifamily, multifamily is also pretty vague. What are we talking? Are we talking about 50 units and under, 50 units to 100 units, 100 units to 200 units, institutional quality assets? And then within that as well, are we talking a class A, B, or C? What location are we in? So this is a very broad thing there. So I think once you're an LP, once you're a fund manager, and you've kind of narrowed down specifically what you're seeking within this, that will also save you a lot of time, because there might be some stuff, as you mentioned there, that you're just not interested in plain blank because it does not align with, as you said, your kind of thesis and values there.
Yeah, and there's even and that's that subtype of the product that we mentioned there. But in addition to that, you have other goals that investors are trying to reach, right? And so we in that next bullet point where we talk about cash flow or appreciation or preservation, right, and figuring out where that priority is, right? Because in its cycles, it's kind of the tail wagging the dog sometimes. Just what the flavor of the month is, kind of, so to speak. But
It's
there
super
could be a lot of people. Yeah, there could be a lot of people that are sitting there going, "Look, I really need cash flow. Like, so whatever deal I get into, it's got to be a cash flowing deal." And they may say, cash flow is of utmost importance, and product type is secondary to me, right? And so you would know that going into these kinds of things, that you're looking for only deals that are doing cash flow to your investors, or as an investor, that's your priority, right? Then you can have people that, hey, look, preservation is of the utmost importance, and so if you want to preserve what you have, and that's the most important thing to you, well, then maybe cryptocurrency may not be that thing you want to go do, right? And I know you chuckle, right? But it's understanding those things as an investor, right, prior to really engaging with all the other things that you have to do from a due diligence perspective that could just save you a ton of time. And then, we obviously put a bullet point there of location, right? Because location is vast too, right? People may sit there and go, "Look, I've invested a ton in the state of Texas where you guys are at, and until you have assets that are outside of the state, right, you're probably not a good fit for me anymore," or vice versa. "Hey, we want to continue to own more in the state of Texas, but we want to be primary markets only, not secondary treasury." There's all different types of things from a location perspective that provide that kind of diversity that investors are looking for. And so, knowing all of these things ahead of time, and really, kind of having a defined set of terms of what you're looking for, it saves a tremendous amount of time of where you put your efforts and energies, of who you're going to be talking to, things of that nature, and whether or not you actually even go into the deal due diligence or not. I mean, just knowing effectively yourself and your investors can save you a tremendous amount of time. And that's why I put it number one, because you really got to know what you're looking for before you just go out there and start, shotgun approaching, shooting out shots, seeing what will hit.
Yeah, and then I think a big thing to think about as well is, and we're probably going to dive into this deeper, but we look at cash flow appreciation preservation. Well, it's really hard to get all those three things lined up, right? The market is very dynamic, the market pricing is set, and you're paying a premium for these deals. You're paying usually top price for these opportunities in most instances, with very rare exception, right? Even an off-market deal, well, you probably paid enough for that property, probably the most where the seller would actually sell that deal. No one's doing you a favor when it comes to the world of making money in business and multifamily or any alternative here, right? It's player versus player at the end of the day. I'm not saying it's 100% zero sum game here, but realize that there's no free lunch when you get involved in this. And if a deal is a certain cap rate or if a deal has a certain return threshold, right? At a tertiary location, well, there's probably a lot of risk associated with that. If the deal has a lot of cash flow, well, then it maybe not doesn't have as much appreciation. And you could be looking at a deal in Dallas, right? The most core location in Dallas, the most core location in Austin or Houston or Phoenix or South Florida, right? Well, if you're buying the best of the best property, you might have pretty low cash flow, and your appreciation, it could be really great, but you could also have preservation. So I think when you look at cash flow appreciation and preservation, you're probably going to get 1.5 to 2 of these things, but very rarely all three of those things.
Yeah, so we used to describe that as if you had, three buckets, you have one bucket of water which would represent your investment. You have three buckets: cash flow, appreciation, preservation. You know, your investment can fill up what you want to fill up, right? So, you just pour into what bucket whatever you want, and that's going to be the desired outcome for what you're looking for in your investment. But you're not going to be able to fill up all three buckets with your one bucket of an investment. So.
Yeah, and location can really skew things. And then, sponsors can play interesting games with regard to, outcomes of a particular investment and engineering that on Excel spreadsheets, but we'll get into that later.
For
Then
sure.
on the next subject, we're going to sponsor, which is super interesting. Sam, can you take it away here, please?
Yeah. So, look, the sponsor, we say you back the jockey, not the horse, right? Probably the easiest way to describe that. And so,
You've heard it a
when you
million times if you're getting into business as well, I assure you, particularly if you're raising or if you're an investor.
very much so. And so, understanding who the sponsor is and whether or not, you align with them, but then there's a lot of things associated with that, right? The first thing we look at when we're looking at a sponsor is, the track record of that sponsor, right? What they've done in the past. So, can they execute the deal? And there's a lot of things associated with that, right? Can they execute their business plan? Can they actually close on the deal that they're presenting you? Things of that nature. Is it their first deal or their 10th deal or their 100th deal, right? How long have they been in the industry and how many deals have they actually done? And a lot of that will come into play too when you're looking at structure and fees and things like that we're going to talk about next. Have they full cycled a deal? You heard Craig talk about Lone Star. We full cycled two deals so far. We had great results associated with that, right? And so if they've done that, they've gone through a cycle with a deal, right? Here's a big one too, and it's one of the things that really has me attracted to Lone Star Capital. It's one of the things that really attracted me to come over here as a partner. Is, are they fully integrated? Now, you will hear people say we're vertically integrated, or we have integration. That means different things to different groups. When you are fully integrated, right, you have the ability not only to in-house, you have your acquisition team. So the people that are helping you acquire the property, they are part of your group, right? You have property management, meaning the day-to-day operations of that property are in your control, right? And you are actually the team that is operating the property day to day. You have asset management in-house, which means the business plan that you have presented to the investors, right, can be executed upon by your asset management team who is working in cohorts with your property management team. And what this does is it gives you full control of the investment. So if your sponsor has full control of the investment, because anytime they bring in third parties to help them, they are giving up a bit of control of that investment to that third party, right? And sometimes it's critical to do that too, right? But the other fourth thing too would be that construction management that we have in-house. So if there are things associated with, say fixing the property, all of these things that are integral to the daily operations of an investment, right, are held in-house. And it's going to be different things for different people, right? And so understanding how integrated they truly are, all aspects of running and operating and owning the property in with one sponsor. And if that's the case, they're going to have the most control of that asset for their investors. Does that make sense?
It does indeed. Now,
Okay.
I really love the next section here, and I'm just going to read it off here. But how are they performing with their current assets, right? That's such an amazing thing to ask. And, it all comes back to kind of the bottom bullet point here, or the main public thing here, which is transparency. How much are they allowing to open the books? Are they going to tell you that everything is rosy and sunny, and then you go through business with them, and then you realize actually more things are coming out? Where is their transparency at? And Sam, I mean, maybe you could speak to the experience of, working with us, working with other people, but can you kind of highlight some, I guess, not so rosy scenarios and some good scenarios with kind of pertaining to asking that question?
Sure. Sure. And and the reason you want to know that is because you want to know where those pitfalls were, right? So if they come back and say, hey, you know what? Assets we acquired in 2022, right? We bought them with floating rate debt. And because we bought them with floating rate debt,
Or bridge.
or bridge debt, yeah, we've been trying to make sure that we can overcome these challenges that we've faced with the property because we haven't been able to cash flow. Okay, well, you know, how are you operating with those assets? They said, well, if we're operating at 95% occupancy, well, all right, you clearly are operating them great. You just you made it a
And you
challenging
made a bad trade.
situation.
You made a bad buy, unfortunately, at the top of the market,
Yeah,
right?
at a time frame where you use the wrong debt associated with it, and it's caused those pressures on the existing asset. But you're trying to operate your way through it or whatever. It doesn't mean that they're bad operators or a bad sponsor at all. It just means, hey, with where you're at, you have some challenges associated with that, and part of your attention is going to have to go to those assets. And I understand that as an investor, right? All right, you only have this much of attention span and you have this many assets, right? To add new ones, how is that how are you going to deal with that from a bandwidth perspective? And that's a fair question to ask, right?
And
Because
can I take this a step further?
sure,
So one thing I really want people to think about, and this has happened over the last course of 24 months specifically, and one thing to think about is all of a sudden tons of analysts, tons of directors, of people doing what I do or Brad does, or maybe something that Dasha does, started reaching out and applying and sending their resumes to groups like us, and I'm sure other people in the industry, right? But I can just speak for ourselves. Why would someone who's at another firm want to leave their firm? Well, because when it comes to performance of the deal, people typically get paid outsized amounts of income, outsized amounts of bonuses, basically based on how deals do. And if you're looking internally at deals that might not be doing very well, you might not have any bonus or upside in those opportunities. So you might as well jump ship to a group that is. So in the next couple of years, when the market does change, you can be in receipt and in benefit of that. Well, why is this a problem? Why am I mentioning this? Well, what if you're going to be working with a group here coming up where the entire team or so on the asset management, property management, the kind of the A players that kind of got you sold in the operation were going to leave. Now they've got to restaff, or they might just fold, turn the keys back, as they say, get foreclosed, or not manage the same way as they did historically, which is a really big problem. So understanding what the firm's background is doing, understanding how the group is doing internally with some deals they have currently, particularly when we go through a market cycle, and frankly, the trees are being pruned right now. There's just kind of problems. Are they going to be focused more so on curing their old assets and aren't doing as well? The deals are required in 21 and 22, as opposed to the new deal that you're potentially investing with them here coming up. These are the questions you have to think about and ask when it comes to track record and things of that nature. Is it a couple of deals or is it an entire portfolio of $1 billion that's distressed here, right?
yeah. Not only that, you're going to want to know that they're it's kind of the catch-22 because you're going to want attention put to the asset that you're talking about investing in. But you also want to know that they're taking care of their investors, right? Because if something happens on the asset that I'm, going to invest in with you here, I want to know if something goes sideways, you're going to take care of me. You're going to give us the time and the attention to do so, right? And so it's one of those things of, do they have a healthy balance? Do they have the human capital to be able to address all those potential challenges that they may have with the current portfolio? Um, that tells you, is this, I mean, it literally leads to the next bullet point. Is this somebody you want to do business with? Because it's not a transactional thing. I mean, so many people feel that this is a transactional thing. This is truly a relationship. I mean, you have to understand, when you do these deals, they are illiquid in nature, right? And so you are, in theory, going to be, for the most business plans that we see, you're going to be a business partner with this sponsor for sometimes up to 5 years, maybe even more. You don't know, really, you really know. And so, is this somebody that you're going to want to continue to do business with for years to come? Because that's the decision that you're making when you invest with a sponsor.
Yeah.
Um,
I
if that
love that.
makes sense.
So yeah, so let's talk about this. Let's think about this. When we take on any new LP, passive investor, limited partners, what LP stands for, passive investor, fund manager, anyone that we'd ever want to do business with, right? We want to have a compounding benefit. And I kind of look at this with anything I do in life is it has to have a compounding benefit or I'm not interested in spending time there. So I also think you need to think about this as well. If you are, as I said, a passive investor or a fund manager, is this someone you want to do multiple deals with? Because life gets better if you don't have to look for a new sponsor all the time. And similarly, if you're a sponsor, your life gets a lot more enriched and beneficial if you find great people to do deals with. And, I think we're a lot of people that got in the business call it in 2018 and newer. Syndication has obviously blown up, right? But if you're kind of in that bucket there, you saw deals kind of cycle in and out, in and out, in and out very quickly. Now we're in a world in which, guess what? Deals are probably going to be held 4 to 8 years, likely, depending on what's going on, that are being bought today, but also those deals that are bought in 21 and 22. Assuming that they don't, lose money, you can kind of hold on to it. Maybe it's not uberly distressed. Maybe it's slightly distressed. Maybe you made a capital call and you extended your debt window. The world is not 2 to 4 year holds anymore. It's probably 4 to 8 years. So just realize that this is a medium to long term relationship we're talking about here. That's a long period of time. So is this someone that you want to meet with? You want to, I'm not saying hang out with, but go to dinners with, make sure that you're trustworthy and comfortable with this person. Do they have the temperament and kind of the tenacity that, would want to be someone you want to do business with? This is just not a quick decision. So you want to get very, very much so in the right bed with the right people here. And, Sam worked with us for a while. Sam was observing us for even longer, right? So Sam, obviously doubled down on that factor, but it's very complimentary that he would want to be working with us after he saw, the intricacies of our company there.
Yeah, I mean, we for lack of better words, we dated before we got married, right?
Yes.
Which is great, right? But the other thing with that is understanding it's truly a relationship, right? This isn't a transactional thing, right? Yeah, I
No.
mean, it is from the perspective of, I'm giving you money and I expect, I have expectations back, but that's along the lines of understanding the sponsor, which leads us into the transparency, right? How do they report, right? Reporting is a big deal, right? Because that's going to be, how open are they going to be able to share, the financials with me? How do I get those financials? What are the logistics to being able to see that? When do I get K1s? And is that all clearly spelled out through the operating agreement that, hopefully you reviewed before you get into these deals, right? But it goes even beyond that too, because, you know, how much are they communicating from a, hey, we have a change in business plan? There is no business plan that goes 100%. There's no deal that does exactly pro forma. I've never seen one in my life. And so if there's a change to the business plan, meaning we get in there and we've decided, hey, uh, a great example of that would be, hey, rental rates are not running as what we had hoped for in our business plan. And therefore, we're not going to be, say, renovating as many units because we're not going to be able to get the dollars associated with it, right? So instead of spending these CapEx dollars, we're going to hold them back right now, right? We're going to get through this cycle of occupancy and supply, and then we'll re-up it at a time frame when we think we're going to be able to earn bigger dollars on that investment. As far as a capex is part of our plan, right? But are they actually communicating that to you? Are they conveying that message to you?
Another
Um,
thing to note here as well in transparency is when you are looking at opportunities and deals, the sponsor and the group that you're working with should be very transparent and should be very open-minded to sharing the underwriting to the deal as how they
sure,
got the projected outcome for the return structure, right? So if a
for
group
sure.
is not being transparent in relation to things of that nature, ask for references, ask for, capital raisers or LP investors who have had a good experience with them, right? Kind of dive deep there. Maybe do a Google search and see if there's any reviews there out there, right? Just kind of go through that process there and poke around a touch. Make sure that they're open minded and willing to give you kind of some collateral, some materials when you're looking at deals and whatnot. So I kind of know the ingredients in the cake that you're about to eat there, if you will. And then another thing I really want to stress on here, and this is really more so speaking to fund managers, particularly if you're starting off or if you're relatively newer. It is the most important part is getting it right with your first couple of deals and with your first couple of, operators that you choose to work with. And although you might get one deal, if that one deal there, if it was underwritten from 10 different sponsors and was managed by 10 different sponsors, you're going to get 10 different outcomes. So really be thinking about who you're working with here. Be thinking about how this business plan is going to be conducted. And quite frankly, your downside is going to be mitigated a lot more if you're working with a good group. But if you're working with an okay group, you might have what a deal that, we might make, pretty solid. They might make a mess of it. So be very careful and very, very much so guarded and smart with who you first start to work with. And your investors need to have a good experience if they want to work with you again. You want to have repeat investors time and time again. And if your distributions are not on point, if your reporting's not on point, if they're not kind of delivering information, if they can't deliver, that's a reflection upon yourself and your decision making ability to kind of capital allocate to certain deals, which is the value that you're providing to them. So please, if you're a fund manager, be very careful with who you start to work with here. It is so important that you're working with the right individuals in your first couple of deals and really throughout, but particularly as you start and you have no track record and you're looking to build yours. Leverage a group like ours who will help you with what we've done historically.
Yeah, because that's going to be what gives you the credibility to continue to raise money, right? The last thing I'll just say on transparency is, are they communicating impacts to the investment? And this is something really near and dear to me because I live in Houston, Texas, right? And so there are all kinds of things like, when we have a hurricane come through, it can potentially impact the investment, right? And if you've ever dealt with any kind of insurance claim or anything, you've had impacts to the investment. And is that being conveyed to your investors? Meaning, hey, big storm came through and we need a new roof now, right? And here's what we're going to do to fix it. Here's the impact that it's going to have on the investment right now. And this is why it's going to be slightly different than what we originally pro forma years ago, right? Because this is something that's occurred, and this is going to be how we handle that aspect. And so, transparency is big, like what you were saying, Craig, and understanding that there's all different types of things that will impact the investment that you cannot know from the very beginning, right?
A lot of things, and kind of just as we put a bow on this thought here, is real estate. When you work with a group like us, it's not just real estate. Sam, we were talking about this yesterday, but it's not just one thing. It's not just the property, the move-ins, the move-outs, but it's truly the entire team that you're working with here, from soup to nuts, from call it the Robs and Sams and the Kens who are partners there, if you will, all the way to the leasing at staff and things of that nature at the properties and the maintenance people and everyone between. You are basically working with a group that has everything kind of buttoned up and dialed in there. So the team is very important. Transparency is very important. So make sure you do a proper deep dive into that. Now we're getting on into structure here. Structure is quite an interesting one. So Sam, why don't we take that away as well?
Yeah, structures is it's really funny because you'll see, in particular with different sponsors, you'll see all different types of structures for for seemingly the exact same deal. It could be under different structures with different people, and a lot of that is just understanding how the sponsor structures their deals. And again, this is something that it doesn't change too terribly much. Meaning, if a sponsor has a structure that works for them, they're typically going to just stick with that structure. But the big question to ask from the whole onset of looking at structure is, how does everybody get paid, right? Because you're going to want to know how your investors get paid. You're going to want to know how you get paid. And you're going to want to know how the sponsor gets paid. How is everybody getting paid based upon the structure of the deal? And a lot of times there's a split, right? You'll see some kind of split associated with the deal, right? And so it could be a 70-30 split or an 80-20 split, or sometimes you can even see 90-10 splits, right? And they're done for different reasons, right? And a lot of things, what you have to do is just ask yourself, does this make sense, right? Because if you're looking at a deal and let's just say it's a 90-10 split, meaning 90% of the returns are going to go to the investor dollars that are putting the money in, and 10% is going to the GP who is putting it together. Um, I would ask why. I mean, because if in typical, I would say standard for our industry, what you typically see is somewhere in that 70-30 split. That would be a typical deal that you would see throughout the industry.
With the
Uh,
preferred return before that 70-30 split. Just to
Correct. So
caveat
a
that.
certain amount of dollars that are going to be going to the investors before that split comes into play.
Yeah, and a
Right.
common preferred return, is somewhere between 7 to 9%, depending on the dollars contributed. And then you've got that 70-30 split. And then there perhaps could be a different hurdle following that after, certain thresholds are met on the deal. But if people are hitting that, that means the deal is really good. And
That's
you
right.
really want to work with a group that has the deepest and hardest valuing of the back end compensation, which is called the promote and the deal, which is the latter half that would come to the sponsor, which Sam, I believe you're getting into that here shortly.
Yeah, and so but it's making sure that it makes sense, right? When you're looking at that structure, understand the why, and a lot of it's going to change depending on how seasoned the sponsor is, right? So a more sponsored, a more seasoned sponsor is going to want probably more the back end because they're very, they've got their deals in place, and they're going to want to more. They're going to want to keep more of what they're, of what they're going to earn on the deal. If you see something like a 90-10 split, it could be that could be a newer sponsor and they're just trying to earn their credibility, and that's how they're paying their way associated with it, right? And there's some risk obviously associated with that too, that you're going to take as an investor when you see something like that, because it could be that this sponsor hasn't seen everything and there's going to be some potential pitfalls that they haven't experienced yet, whether it's being, haven't gone through full cycles or not. Um, and understanding how those splits are arranged will tell you how everybody's going to get paid in the deal, right? Now, you also have what we call front end versus the back end compensation, meaning how much money is the GP making on the front end of the deal versus that back end. So that split that comes into play, right? And so, if they're front end, if they're putting a lot of the fees associated with it on the front end versus the back end, it means the sponsor, the GPs, are typically making more of their money up front doing the deal and less of their money on the back end. And that can be okay, but it also can, cause you to think a little bit and going, well, how aligned are we? Are you doing deals just to be able to do deals, right? Or is it's something where you're aligned with the investors and the bulk of your comp's going to be on the back end? And it could be an investor wants that, right? We may want it to where, hey, you're not going to make as much until we all make as much on the back end, right? And it could be that that's part of your alignment, right? And understanding those front end fees versus the back end fees that a sponsor would make in the deal is very important. And what's normal, right? And so those common fees associated with that. So it
Yeah,
could be
well,
that,
I have
yeah.
a
I mean, go
yeah,
ahead.
I have a couple comments here. Do you mind if I interject?
Let's see it.
Yeah, so front end and back end comp, and this is something that's really kind of contentious within the space and business, but just realize there's no free lunch. And probably the best sponsors out there, the ones who can raise the most capital, the ones that have the best relationships there, if you will, that have got the best equity sources, are likely going to be the ones who defend and fight tooth and nail for the best splits possible. And you're going to probably want to work with the groups that have the best splits possible, because that means they probably have the best access to capital, which means they've got something, going for them that works really well for the most part. And then parlaying that same into fees, what's market, what's common. What would you say in your experience is a market and equitable kind of acquisition fee, asset management fee, construction management fee, disposition fee, refinance fees, you name it, right? What would you say is appropriate in market in that space?
Well, yeah, you kind of hit the bulk of the fees right there, right? And so, from what I've seen, I would say, if you're looking at an acquisition fee on a deal. A lot of it will come into play with size, but let's just say it's 2%, right? So meaning the GP is going to make around 2% upfront on the acquisition of the deal as a fee, and that's going to, what they're using that fee for is their pursuit cost for the deal, and all the sunk costs that they have in trying to go and acquire that deal. Because there's a lot of time, effort, and talents and resources that they're putting in to go acquire these deals. And the acquisition fee is something that helps offset that pursuit cost. But in addition to that, right, you mentioned an asset management fee, or sometimes referred to as an AUM fee. And there's different ways that you see that being charged too, right? So you'll see people say, hey, the asset management fee is a percentage of the gross income for the property. And I would say that's the most typical, meaning, we're going to charge between 1% and 2% of the gross income of the property is going to be our asset management fee. But we also see it where they'll actually charge some kind of percentage based upon the dollars that are raised, meaning the equity that's being placed into the deal. And so a lot of times if you go that way, it's a very different number. And so having to understand, how they're getting paid associated with the asset management fee, it's a very different number when you're taking it based upon the earnings of the property versus the equity that you're putting into the deal. A refinance fee, if that's part of the business plan, right, it's typically somewhere in that 0.5% to 1% type fee, because they're building that into the business plan associated with the deal. A lot of times you'll see property management fees, which can range, depending on the size of the deal, anywhere between that 3 to 5% of the gross revenue, the gross receipts of the property. And so there are a lot of fees associated with owning and operating these properties, right? But you also mentioned construction management fee. I would say typically it's like 5%. So if there's a big, CapEx that they're going to be doing to the property, say there's $1 million CapEx, there's typically a fee associated with the oversight of that CapEx, right? And that's where having construction management in-house is also helpful for something like that, because you're going to know what you're going to want to do, how you're going to want to do it, and getting the best pricing for the investors in that deal. So that would be some of those common fees. And then, if it's outside of those, right, if there's something that's outside of that norm, right, you would hope that there's reasons why. There are complexities to the deal where, there was a greater pursuit cost associated with the deal, which would make us have to charge a higher acquisition fee, meaning.
Yeah, and I'll open up the curtain here a little bit further, just in the honor of transparency, as we alluded to earlier in the slides. We charge at Lone Star Capital on a market rate opportunity a 2% acquisition fee. We will charge a 2.5% acquisition fee in rare exception. What is that rare exception? Well, it hasn't been so rare recently, but that's on our tax exemption opportunities. Why? Because there's a lot more nuance in structuring and fees associated on the front end to kind of pay ourselves back there. So we'll charge 2.5% in that opportunity, right? So typical 2% on a value add market rate deal that wouldn't be in a tax exemption opportunity. And then once more, tax exemptions, probably about 2.5%, considering all the nuances in what we're delivering to the investor there. Our property management fee is about 3%. And or 3%, not about, it is. And our asset management fee is 2%. So people, typically speaking, when they add those two things up, property management, asset management fee, they call it, okay, 5% there, which is pretty market and common.
And that's 5% of the gross receipts of the property.
Correct. So make sure that it's of that. When you're starting to move around as to how those fees are created, they could be creating the sponsor could be creating a disproportionate amount of money, where if you're newer, you may not realize how the cookie is crumbled and how the cat is skinned there, if you will, right? So make sure that you kind of have an understanding as to how they're making money. Is it in line? Is it not in line? At the end of the day, you got to realize, if you're an LP or if you're a passive investor and a fund manager, that, hey, these people do need to make money. They do need to keep the lights on, but it shouldn't be egregious. It shouldn't be so aggressive that it's out of marketplace, because that's just not common. It's not, as you said here, common fees there, right? So 2 to 2.5% is what we'll charge on acquisition fees. And then 2% on asset management, 3% on property management. like everyone else, typically, or like most sponsors who are in line in market that are quality, 5% of construction management fees there, if you will. And then we don't have a refinance fee or a disposition fee. Which is super important there. We'll just make that money ideally when you do well and there's promote to be gathered. Upside of the deals need to get past that preferred return threshold there. Sam, did I miss anything else you'd like to add to
No,
that?
you've hit the fees, right? I mean, that's what it is. And so, and understanding what those are from a typical perspective, right? And realizing that, hey, if something is, far greater or far less, you just want to know the whys, right? So if somebody comes to you and says, hey, our acquisition fee is 3.5 points, right? You may go, okay, well, this seems pretty heavy. Can you tell me what your pursuit costs are? Can you explain to me why that's your standard? And it could be that they have very valid reasons for it, right? There's, could be that they have high legal bills associated with it, and that's just their business plan of how they go about it. But it's understanding, why they're charging what they're charging associated for it. In particular, if it's outside what we would call the normal for for our industry.
And I'm going to caveat this once more. We are a multifamily owner, operator, and sponsor. Perhaps if you're doing, anchor retail grocery stores, if you're doing ground up development, if you're doing a different asset class, this might not be as applicable. So I'm not speaking to those people. You could be well and fine. There could be fees that I'm not privy to in other spaces, perhaps self storage, whatever it may be, construction, development, so on and so forth. That is really not what we're speaking to here. We're just speaking on, existing value add or existing multifamily opportunities that are built that are not going in construction.
Yeah, and so each of the asset classes, it's a little bit different associated with it, and so, and then for the last thing on the structure, if you go to the next slide, it's the capital stack and understanding where you are in their capital stack and how they're raising money for their capital stack, and it's a risk reward thing. So the lower you are in the capital stack, the lower the risk is associated with it, and the lower the returns you're gonna see. So on the debt side, you're going to see, call it the bank or the lender, right? They're typically going to be the lowest risk investor in the deal, right? They're lending the money. They're typically, the largest investor in the deal because we typically leverage more than 50% of the deals that we're acquiring. But for the most part, they have a small fixed rate return that they want associated with their position, and that's why as you go up this capital stack, the return should be higher for each of those, but the risk associated with it is higher. And so, for the bulk of the investments that we look at, you are in that highest level, which is the common equity. And one would think that if I'm in that highest level, I'm taking the highest amount of risk associated with the deal, you should get the highest return, and that is how most structures are structured, right? You have the debt and you have the equity that's above the debt, right? The debt's always going to be repaid first, and the equity will be repaid last. And so there's different types of equity, there's different types of debt associated with it that we have in this capital stack. But that's really what most people need to know is it a typical capital structure where the common equity coming in is the highest, and then if you go, well, if I'm going to have a prep position to it, am I ahead of the common, right, associated with that? Because I'm taking slightly less risk, but I may not be getting the kind of return that common equity is getting. So the pref equity, which you're seeing a lot of people putting out pref equity in the form of debt out there, they should technically be in front of common equity and should be getting returns that are less than what common equity is going to get paid. And so
Theoretically, if there's
theoretically, yeah, but
if
that's
there's
the
use
capital stack. I mean, and this is a very typical capital stack too of how you're doing it. You don't necessarily have to have all these things. You can have just two things, your debt and your equity, and that could be one thing.
Yeah, I want to touch on that. I want to touch on that actually
All right, go
because
ahead.
some of the riskiest deals that were done had senior debt, shorter term debt, mezzanine, and then common equity in there. Mezzanine is basically another layer of debt, effectively, to the deal. It's going to get a fixed rate of return, kind of like the senior debt there, and then that could really juice up, exacerbate your common equity returns, but it could also eliminate them entirely. Similarly with the pref equity deal, right? So typically speaking, a preferred equity deal will have a coupon associated with it. What does that mean, a coupon? I'm not talking about going to the grocery store and getting discounted beans. I'm talking about you're getting a 14% IRR potentially. You're getting a deal preferred equity structure like a 6% current pay and then a ladder amount accrual. So basically, if the deal doesn't do as well as projected, that preferred equity is still entitled to that, and the common equity person can be held left with very little or low return, or a substantially higher amount return because if they get over that set threshold called a 14 or 16% and the deal's a 20, well then congratulations, you get all of that and then some. You get the remainder there. So that's super important to think about and to also realize. Just so you know, here at Lone Star Capital, we've only ever done one deal with preferred equity in it before. It was a deal in Dallas. It was our Grand Riviera opportunity where we really actually liked the structure of it, the hold period, so on and so forth. So we felt comfortable there. But know when you're working with Lone Star Capital that you're working with a deal that has senior debt and likely common equity. And also, if you're an investor, realize and know what's going on if there's preferred equity, mezzanine in it, and what the potential ramifications and outcomes could be if you're a capital raiser or a passive investor. But just to go a step further there to think about is know your risks there. Know if you're investing in a deal, if that's in there. And also before closing, I've heard instances and horror stories of people actually throwing in a mezzanine sliver, preferred equity sliver. Well, that's to me unethical. And dare I say, is it illegal, same if that happens, or not kosher, depending upon the PPMs and things of that nature and the operating agreements, stuff like
Yeah,
that?
the PPM would probably dictate that, right? Or whether or not they even need to disclose. But what I would tell you is if that that falls back into that transparency, right? Of hey, the business plan has changed, right? We've changed the business plan. We're having to take in this kind of sliver of equity to close the deal. We're having to take in this sliver of equity to be able to do something else associated with the business plan, right? And so in theory, you would want to disclose all of that to let people at least know, hey, there's been a change to the business plan. So,
Awesome. Now the deal, everyone loves
yeah,
the deals. We're
I
all
know.
doing.
We finally are at the deal, right? We've gone this far, and we're just now getting to the deal, and that literally goes to show you, like all the things that you do before you even look at the deal, right? But the beauty of it is if you know your investment thesis, that's one thing, and that can change, right? You could be looking for different deals at different times. Um, if you know your sponsor, that typically you go through that exercise really once because that sponsor is probably not going to change what they're doing or how they do it, right? And the structure could change slightly, right? But understanding what the structure is to that sponsor, it may not change too much. So once you go through those first three exercises, you've taken care of the bulk of what you need to take care of to be able to then go and analyze the deal, right? And so, finally, you're going to look at the deal, right? And I always just kind of chuckle because we've gone through all of these steps to just now get to the deal, right? And so you understand why it can take some time for people to actually invest with you as a sponsor because they got to go through a lot of these steps, right? If they're doing it the right way before they can even get to the deal. And so when we get to the underwriting, because that's really where the deals start, you start with the underwriting, right? And you'll get the underwriting from the sponsor. And the first thing you want to look at is, does this make sense? But what we tell all investors, all fund managers, is to underwrite the deal yourself, right? And if you underwrite the deal yourself and then you compare it to the underwriting that the GP or the sponsor provided you, right? You want to see where there's variances, right? And then you want to question those, right? All right, hey, I have a variance. I did in my underwriting, and it could be that you were wrong the way you did your underwriting, right? But it could be that there's something that's different that needs to be answered, right? And so does the sponsor, when they're doing that, do they have good answers to your questions, right? This is going to be something that's critical because if the sponsor is making assumptions based upon something that's different in your underwriting, right? The deal may or may not fit, right? Great example of that would be, you have a good understanding of the submarket for Houston, right? and you know that from all the reports you have, whether it be CoStar or Yardi, that you're doing your underwriting with, and it tells you, hey, Houston this year will experience 1% rent growth, right? But the sponsor is using something that says, hey, we're going to have 8% rent growth this year. Well, that's going to change things fairly drastically in a pro forma. And you would want to know, hey, what is it that you're going to be doing that's going to make this have 8% rent growth when the market's telling us one? And the thing is, there could be valid answers for it. Hey, part of our CapEx plan, we're going to be adding all of this and it's going to significantly boost rents. Okay, well, then maybe that works, right? But if they don't have a good answer to that question, it may be a deal that you need to pass on. And so, understanding the financials and the underwriting is critical, and particularly for fund managers and LPs, those passive investors, is understanding what you're getting into. And if you have the ability to underwrite it yourself, or you have groups that'll help you do that, it's good to understand the underwriting from your own way of looking at it, not just the way that the sponsors presented it to you. So you have a true understanding of the deal itself. Does that make sense, Craig?
It does indeed. Let's keep going. I got
All
no
right.
here. Let's see how good you are.
Yeah, I know. Here we go. All right. Now, the business plan itself, this is really what gets interesting, because the sponsor is going to tell you what they plan on doing to the deal to make it have greater value than where they're buying it. Right. So, they're going to tell you all the things they're going to do and why it's going to make sense that you invest in the deal. And so, one of the first things we look at is, hey, for the market that this deal's in, does it fit? Right. Because there's all kinds of things that you can do, right? But for the market of where we're at, does this fit? And so one of the things we say is, does it make sense? If you're going to acquire, an active community, 55 and up active community, right? And part of the business plan is to add a heavy tech package there. Being somebody who's of a little bit older age too, I wouldn't want a heavy tech package in my unit.
Boomers don't want tech packages, Sam. What do you mean?
Yeah, exactly. I'm just saying it may not make sense for that particular market, and to understand, how what they're going to be doing, just put it through the straight up logic test, and you'll be able to figure out some of these things. Do they make sense to do, right? But the other big thing, and this is something we could probably do, another podcast on, is cap rate. The entrance and exit of the cap rate, because this can wildly change the value of the property. So if you go in and let's just say we acquire a property, and let's just say we pay a 5 cap for the property, right? And our business plan is such that 5 years from now, we underwrite that we're going to sell it at a 4 cap, right? Well, that one difference alone can drastically change the value based upon things being the same, right? And so if we're able to increase the value of the property because we've compressed the cap rate, right? It's something that you would want to know, and does it fit? I'm not saying that it couldn't happen, but you're going to want to see how that gets shocked, meaning in the underwriting, how you would shock the cap rate and go, all right, well, hey, if it's not a 4% in 5 years, but it's a 5% in 5 years, where is the value of it? Or worse, if it's a 6% in 5 years, what does the value look like with all the things that you're doing to your business plan? And am I comfortable taking on that kind of risk with changes in potential cap rates down the line?
Yeah, this goes back to the phrase that should be discussed and discussed again, which is stress testing. So, what does my base case look like? What does my best, rosiest scenario look like? Which is likely, more often than not, what the projected modeling looks like, because we all believe the deal we have will do what we think it is. And in good faith, that's how everyone acts, and that's how you invest. But what does it look like if things really get distraught? Like rent growth doesn't actually grow at all for 5 years. What if the expense ratio is thrown off a bunch? Meaning your cost of the property exceed the growth of the income on the property. What if the cap rate expands 150 basis points? What if something, right? Yeah, that's called
Sure.
a stress test. To make sure that you are working with a model. Obviously, Rob wrote a book on this, so his model is great. But in the model that the sponsor is presenting to you, or your model, make sure that there's some resiliency to the deal in and of itself. And he goes back to capital preservation beforehand, which is the alignment section and whatnot, in the structuring there, if you will, in the kind of agreements. I forget the exact subject there, which is what would happen if things didn't go so well, and preservation of capital is something that's there. The better the market, the safer the deal likely is going to be. But just realize that, these opportunities are very interest rate sensitive. They're also very cap rate sensitive. There's obviously a correlation between those two things there. Well, what happens when, the market in cap rates went a lot higher? Well, guess what? Cap rates also expanded as well. So just know how your downside could be protected and how, your downside could kind of fall out from there and the worst case scenario could occur.
Yeah, and so along with all of that too, because I'm going to try to wrap this up, is understanding your delineated market area, and really that's not just, hey, we're investing in Houston. It's, hey, where this property is, look around, call it a few blocks, then a mile, then 2 miles, 3 miles, that market area that you're in, because you cannot change your area. You can do everything to change a property. I mean, you can move into a terrible area, scrape the property, build the Taj Mahal, but you're not going to change the area that you're in, right? And so if you can't change the area, is it still going to be an area you want to invest in, right? And so understanding that, by looking at market surveys and the comps that are in the area, is this something that is desirable for the business plan that you have associated? It doesn't mean that you have to live there, but for the business plan that you have for the investment, is it going to work in that market area, and are you going to be able to achieve it? The demographics is the other big thing too, right? And understanding if you're going to invest in a particular location, right? No matter what the asset is, are the metrics and the KPIs, the key performance indicators for that area, positive or negative? Meaning, is there desirability for that area? Do you have growth in population? Are there good jobs? Is crime low? Are there good schools? Is there desire to be in that area, or is there negative connotations associated with the area, which could depress whatever investment that you're going to be investing in for that area? And so there are a lot of things associated with it, but obviously it starts with the underwriting and matching it up with what your investment thesis is. And so as we kind of wrap this up, it's those four. These are the four things, and the irony is, once you do the first three, right, you're able to go through that exercise, and you're able to It's an easier way to evaluate the deal itself, because whether or not you even get to the deal, you'll be able to condense what you're looking for, because you'll have a great understanding of what kind of investment you're looking for, both type, location, subtype. You'll have a great understanding of who the sponsor is that you want to invest with, right? Or sponsors, I should say, right? You'll have a great understanding of the structure, right? Of before you're putting your dollars in, how everybody's going to get paid for it. And then you can go look at the deal, and it'll condense the amount of deals that you're looking at tremendously. I mean, it literally will throw out probably 95% of all the deals that are out there that you just don't need to waste your time on, because it doesn't fit one of those first three categories. And so that's kind of how you save so much time associated with this, and you're able to burn through a lot more deals and just focus on the ones that really are going to have legs that you may have interest in.
We're hoping this 1 hour saves you hundreds of hours, and I really do think it will. So, Sam, thank you so much for this incredible presentation that you'll be doing here coming up. I think what you should do at the event is tell everyone, hey, be present, be here, because we have a longer winded version of this presentation online at your leisure to watch. That said, Sam, as we wrap up here, any final comments that you have to share that we think we might have missed or you'd like to harp into more, perhaps?
Yeah, I mean, before you invest in anything, invest in yourself. Understand what it is that you're looking for and what you're trying to obtain out of an investment, and you'll go a lot further and a lot better with the conclusion of those deals.
Yeah, and remember, if a deal seems too good to be true, it probably is. Okay, so make sure that you are being wise. You are not getting greedy with regard to the structure and the return profile that is projected. We don't guarantee or promise anything at Lone Star Capital other than a great experience working with the team here and controlling the variables that we can control. So just be very prudent with your choices here. And just so everyone knows, our goal at Lone Star Capital is to work really hard to develop the correct relationships with the right people who are smart and sophisticated. And in 10 years from now, we don't plan on really bringing in, or even sooner than that, we don't plan on bringing any new investors with rare exception here coming in. So get in while you can here, while there's an opportunity before we are only working with our existing people. The goal and the structure and the strategy is to move forward via 1031 exchange from deals to deals with our capital raising partners, our fund managers, if you will, our 1031 exchange partners, and our passive investors, our LPs alike. So thank you so much for watching this show today. We really appreciate it. If you think this is valuable for someone else to be listening to, if you think this is valuable for someone else, you think they need to hear this or they would really benefit from our content, please, please, please send this to them. Also, if you're watching this and you haven't reached out to myself or Sam and the team, I don't know what you're thinking. If you're especially if you're interested in working with us, so please reach out to us. Sam, how can people find you?
Yeah, for me, it's real simple. I mean, I would say go to the website. It's the easiest way to sign up and get into our ecosystem. It's probably the best way. Then you can get all kinds of updates. But if you want to reach out to me directly, you can email me, Sam at LSCRE. And that's how be happy to communicate with you guys.
Absolutely. Well, thank you so much, Sam, for this masterclass you provided. Sam and I are honestly going to keep doing this moving forward, by the way. So this is the first of many kind of sequences like this. If you think there's also a subject or a topic that you would want us to talk about that's really near and dear and important to you, maybe there's a case study, maybe there's any information that you're looking for. Sam and I are a resource for yourself. Sam and I are here to help you, kind of guide you along the process. Sam and I both made mistakes in our careers. We both, have never been perfect because no one's perfect. But we have made enough mistakes. We've seen enough deals. We've seen enough opportunities and experiences to know to maybe get you out of a pitfall or two here. So lean on us, refer back to us. We'd love to help you. For those listening, we appreciate you, and we'll see you next week.